Good day, fellow investors. S&P 500, I said I would analyze 25 of the top S&P 500 stocks, so here we go. I have analyzed 6 of them. You can find the links to the Amazon, Tesla, Apple, all in the description below. And in this video, I'll give an overview of what's left. 19 stocks. I have made this table with valuation based on the free cash flow, yield, what is the expected growth for the companies, what is the expected investing return, what are the key risks, and next week I'll make a special video just discussing the S&P 500 general investment risks, because this is 40.54% of the S&P 500. Just 25 stocks is 40%. The other 480 stocks is the remaining 60%. When you get to a valuation, also what we'll use in the free cash flow yield, if the price earnings ratio is 25, that means that 100 divided by 25, the earnings yield is 4%. That's the average for the S&P 500. And then you have to see how to implement this for specific investments and, of course, regarding growth. So let's explain one by one those not analyzed in this video: Apple, Amazon, Google, Tesla, Berkshire, and Facebook. You can find the link in the description below. I'll just touch on the key factors that I see relevant for a position. What are the expected returns, the key risks, and then you will see out of the 25 which is the best or most interesting for you. If you really want me to dig deeper into one of the 19 mentioned here, please let me know in the comments, and the one that's most commented, that one I might make a video that digs deeper. And of course, if you enjoy this analysis, smash that like button and consider subscribing if you haven't, and smash that notification bell to get notified when a new video that I hope gives you investing value over the long term is out. So let's immediately start with Microsoft, and the yield is low at 2.7%, the cash flow yield, but the expected growth, the growth that the market expects, and Microsoft too, is in double digits, around 13%, and that should justify the stock price. If we look at Microsoft, so great revenue growth over the last years, but you have to keep in mind that there have also been bad periods for these companies, all of these companies, and now everything is booming, stock prices are extremely high, but there were bad periods too, and for some of them I'm sure bad periods would return, and that's something we have to keep in mind as the risk out there. You can see also free cash flows didn't go anywhere, didn't grow in the past, and then we have seen the boom. If we look at Microsoft's stock price, you can see that when things are not growing, everything is pretty flat, and then given low interest rates, which is a huge factor, we see a 5x of the stock. That's really remarkable. That is also a problem, because you are now buying something at a market capitalization of 2 trillion, and just 6 years ago it was a fifth of that. And of course, even the metrics were different. Now we have a price earnings ratio of 30 and a dividend yield of less than 1%. But of course, Microsoft hadn't been growing 6 years ago. Now it is really growing fast. And if we look at the most recent quarter, it has been growing 20%, which is staggering for such a big company. And of course, they have Office that is growing, and they are going to the cloud with Azure, so 46% growth there. So that's really a great number for a big company. And also Windows and everything, 25% growth. But growth also means risk. There is regulation, and when you make so much money, every competitor is going after you. So that's what we have to balance: the scale that these companies have already achieved, the risk of others coming and taking a share of that pie, and then of course asking the question, how much room is there for Microsoft to grow even further? Because if you look here, $60 billion, how much more profits can Microsoft make? Can they go to 120 billion, to 180 billion, so 3 times more? and then they will stop growing, or will they grow forever? That's a big question, and the question that might not be relevant yet, but will be at some point in time. You probably expect also this. I just made it for Microsoft in this case, and the valuation. You can download this table for free in the link in the description below. I have made the valuation for Microsoft. I have put in 60 billion of cash flows, 13% growth as expected, 10% for the subsequent 5 years, discount rate like an expected returns of 10%, and the terminal multiple of 20 on the cash flows. Now the multiple is almost 50, but if it returns to, let's say, normal, then the intrinsic value for Microsoft is 1.2 billion compared to the 2.1 trillion, then Microsoft is severely overvalued, and at current levels it should bring to a return of about 5-6% if this scenario develops. 5-6% is not bad, but not even great. Of course, if the growth rates are higher and the terminal multiple down the road is even higher, then we, yes, are there, but I would say priced for perfection there. In the worst case scenario, with slower growth, 7 and 5% with a lower terminal multiple, the downside is 75%. This is in market capitalization, billion of dollars. As I said, you can see also the other comparisons here and download this table for free. Next stock is NVIDIA. So NVIDIA, I will discuss Intel tomorrow, so I'm really curious also for a comparative reason into NVIDIA, and you can see that the stock did really great, 100 times up almost over 10 years. We have seen especially this amazing boom since 2020, and of course when something flies too high, then it returns down. And many ask, is it now an opportunity? Well, it was here. So when there is so much exuberance, there is a lot of noise. Let's discuss the fundamentals. The yield is just 1.4%. That is because the expected growth is higher than 20%, so incredible growth ahead. But even with high growth ahead, I don't expect a great return because of valuation risk, growth risk in a cyclical competitive environment, because the competition will be after them. NVIDIA did really great, but the current market capitalization is more than 500 billion and the cash flows are 7 billion. Of course, if this doubles, then it will look better, but even if it goes up 3 times, which is staggering, even then it will look expensive. Price to sales is 20, the dividend yield is irrelevant, and the price to book value, okay, 20 times, not relevant for such a company. However, how much can this grow? The environment is good, and they have increased revenues 33%, but these are really special times, I think, also for the sector. Everyone is banking on booming of all what will happen in the future, but there will be ups and downs for all these sectors. So again, at this moment it's priced for perfection. 8 billion free cash flow for the next year expected, and that's still not that much compared to the market capitalization. And there is another thing, of course, NVIDIA designs, outsource everything, but for how long they will be able to just do that and stay competitive? So NVIDIA will invest 1.6 billion in growth, and Intel will invest 30 billion per year in the next year. So this is pretty big competition. Okay, not directly everything against NVIDIA, but something to think about how these cycles develop and how much cash flows are these companies making. So you can see here the investments are really low, and the question is, okay, how will it look? Will they dominate? Never has a company dominated, especially as the times move that fast. So for that price, for me, this is extremely risky. More about Intel tomorrow, where I'll present my research platform, which is what I do. But now let's go to United Health. There is a really good free cash flow yield of 4.3%, extreme growth in earnings expected from the management from 13 to 16%, like the great times, will keep on forever. And if they hit this, then returns should be even 15% per year if they hit this. The risk, of course, this is US health, and it is questionable whether there are market forces, so a lot can happen, especially with the debt the government has there and with the pricing and everything. Who knows? There is a risk. Nobody thinks about that risk, but there definitely is. If we look at the numbers, really stellar growth there, a lot of acquisitions that enabled the growth. The stock exploded over the last 15 years, so just up and up, and now the price earnings ratio is 27, so really pricing in great times ahead. But one must keep in mind that good times can also be followed by bad times, and I wouldn't be surprised if we see a negative. It's a really difficult business, but for now they are scaling everything in the health business and really achieving great growth, so nothing to say there. But I'm also not a specialist on healthcare, and you will see later in pharma. For me, I just look at the simple things and I understand the reward, but also there is definitely risk. JP Morgan, okay, investment bank, and if you're asking yourself, should I invest in JP Morgan now? I look at this beautiful price earnings ratio, just 8.5, dividend yield of 3.03, then you have to ask yourself, what does JPM do? They're an investment bank. So if you invest in JPM now, you're investing at the pinnacle of their performance. When everything goes really well, when there is plenty of money, they do good. But don't forget, this is an investment bank, and when things go south, those really go south. That's the risk and reward. And if you look at the numbers, JPM is a good company because it measures its performance with book value per share, and you can see that it didn't increase that much with all the money flowing into the sector. Now earnings have been really great at $15 per share, but it wouldn't surprise me to just get back to normal, and then you understand also why the price earnings ratio is so low. Of course, it looks cheap now, but from an average long term, and especially economy risk, if things get ugly, if we have a real recession, that's something we'll discuss more next week, midweek, for the S&P 500 overview, then things could get really ugly. So that's the risk and reward, and that's why JPM is priced as cheap, or it at least looks priced cheap. Next company, Johnson & Johnson. Free cash flow yield in range with the averages, growth expected ahead not that much, but if you combine it, then you have a return of 7%. But if there is valuation, legal issues, drug patent expiration, and getting new drugs, that is the key risk there. However, J&J has been doing really good, slow and stable growth, nothing spectacular. Cash flows there, nothing spectacular, but really stably growing over time. The dividend has been growing, but I would like to focus here on really how the stock evolves. Now you're buying here, but I remember 2015 there were asbestos issues, whatever, there were always some issues. So if you want to buy a company like this, it's not even that expensive, price earnings ratio of 21, so expected returns higher than the other comparatives, but you might want to wait for some short-term negative news, because that's what the market is focused on, and then you can allow for the compounding to work. But even if you buy it now, nothing wrong with it. The return should be there if there are no disasters. It's a great company. Any company mentioned here on the table is a great company, will likely do good with some disasters there, definitely, but that is investing. Next company, P&G. So again, free cash flow yield in line with the averages. Some say 9% growth ahead, but let's say 3% in line with history. And then, of course, the question is, what's next? Will there be more or less competition? And the valuation is, of course, a risk. So market capitalization 347 billion, PE ratio of 25, dividend of 2.4, in line with market averages. However, you can see that it was much lower just a while ago. So what has changed? If we look at the numbers, nothing much has changed. Okay, they sold whatever low margin and everything, and they are back to growth. But if you look at over time, the growth isn't there because, of course, you sell the bad, buy better, and that was the strategy. And also, if you look at the free cash flows, those didn't grow that much. They are doing some buybacks, but again, not that much. There is the dividend, of course, but then nothing special there. So the reward will likely be in line with the market, depending on what happens with valuation, interest rates, etc. Visa stock really boomed over the last 10 years, and now it is a little bit going down, but you can see that also it didn't do much over the last 2 years, and the price earnings ratio is really high for something that's not that stellar. I've made a video about Visa 2 years ago, and since it didn't grow, and you will understand how these growth stocks are valued, the delta of the delta tool. So what happens if the growth is less than expected on high valuation, and how that impacts investing risk? Because, of course, high valuation, this means priced for perfection, and if the perfection isn't there, then you have some issues, and that's what you're seeing now with the stock price. The environment is highly competitive, the growth, okay, is there, but not even that much. They have really good cash flows, that's a benefit. However, everyone is after them, even if they have a really good situation. Economy crashes, recessions, there is always risk, and the risk depends on how much you pay. So if you pay a lot, then the return is automatically lower and the risk is higher. I would say that for Visa, really perfection is priced in still at a P ratio of 40, so one should be really careful when it comes to Visa. Home Depot, again, free cash flow yield in line, expected return, the market expects 8%, but that again depends on all things valuation, growth, economy, and they did really well over the last years, but at some point the growth will slow down a little bit, and then you might check if everything else like the free cash flow is still as healthy as it looks now. Of course, nothing wrong with the business, everything looks really well, so it again depends on the price, and that's something we cannot predict. Now, Exxon, I've been looking at Exxon for the last 6 years, and it's one of the worst qualitative businesses in the big oil sector. Of course, returns cannot be calculated here because it depends all on oil prices, and nobody knows whether oil will be at 20 a year, 2 years down the road, or at 250. That's always impossible to predict. If we could, we would already be the richest people in the world, as nobody can do that long term. Then you have to buy when things are looking bad and sell when things are looking great. Now Exxon is making a lot of money, will make even more money this year if oil prices stay high, but you have to also understand that oil is cyclical and that cycles will be inevitable. Then when it comes to Exxon, they are making 48 billion in operating cash flows and investing also a lot to keep production, so making around 20-30 billion there. And then it again depends on how high oil will go, but now their investor presentation projects everything to 2027. 2 years ago they were expecting to reach their targets by 2025, so I don't know why the delay is there. So when it comes to Exxon, others, we'll see later, Chevron, are doing things a little bit better, so you can wait, but that's priced in with Exxon. Of course, it is cheaper, it is cheapest from the big oil, but it all depends on oil, and I prefer focusing on oil like I did the Suncor video or Shell video in 2020 in September, when it's really cheap, when it's close to production costs. Then you make money when inevitably, as the cycle goes up and down, things improve. Now when things are really good, the risk is too high for me in relation to potential rewards. MasterCard, even lower yield, the growth is expected to be higher there than Visa, but again, valuation, growth, economy, nothing much to add there, same as Visa. Bank of America, one of Buffett's darlings. If we look, he has been buying over time, not really since the stock went up. That is also an indication of the risk and reward of investing. He also has some limits. He's not allowed to own more than 10 or 20% of a bank, so that's also something to keep in mind. Bank of America, they project that as interest rates go up, they will make double their money, but then again, depends if there is a recession. If you suddenly have to pay double the interest, how will that impact consumption spending? So it's really impossible to predict. Likely a good bank, but again, if it gets to 60 billion, the P ratio would be 5.5. That's not uncommon for banks, and you can see the risks there when things go south. So we are again, everything looks great here, now a little bit more crisis, but these are banks and you never know how will those work out in the long term. I'm not a specialist on banks, therefore I can't help you, and I'm just going to tell you one thing that's different between you investing in Bank of America and Warren Buffett. When there was trouble 10 years ago, Warren Buffett simply made a call: do you need 10 billion for preferred shares with a coupon of 9%, where the downside for Warren Buffett is 0, the upside is stellar, and that's something you can't do. And Warren Buffett knows that if Bank of America gets into trouble, he can easily give them 20, 30, 40 billion dollars at a great coupon, diluting you, having absolute protection for him. And those kinds of deals is something you cannot make, and that's why also he knows that there is safety, but depends on how you as a shareholder will look at that over the long term. Next stock, Disney. 2 years ago I made a video where Netflix, or the streaming part of Disney, wasn't even priced in, nobody cared about that. Then suddenly the market started caring, and now it doesn't care again. If we look at the stock price, so didn't really care about Netflix, then it boomed of course, then very bad as the parks closed, then booming, and now again the expectations, or it's not really going as fast as expected. Now it is down significantly, but the P ratio is high again, or we have to consider also the situation there for Disney. I have taken the pre-pandemic free cash flow, and that is in line with the market, 4%, 5% expected growth. Let's say when you mix things, then the expected return is there if the valuation stays as it is. We said 9 billion on the market cap of 243, so that's 25, which is then again perfectly in line with the market, but for me that is too high. Here you have the cash flows. Of course the growth is there, this should even improve, so cash flows should get to 15 billion when all returns to normal, the parks and everything, but there will always be issues, so keep that in mind. If you want to accumulate a great business, better to buy when things look bad, like it is now the case for Disney, but always mind the price. Another oil company is Chevron. Of course, depends on oil on long term, and here I want to really discuss the risks. Now oil prices are high, but everyone is predicting stability of production or even growth in production. So if they invest a lot of money, and if the bad cycle hits again in 2026, you will not have made much money if the stock crashes 50% and you collect 5 years of 5, 6, 7% dividends, that's the risk and reward. But when it crashes here or there, and eventually big oil, we'll see how it works, but the outlook is for high competition, thus low cost. Eventually this won't look that great, so there is a certain risk, and therefore really better to buy when things look really ugly. Of course, if oil prices stay high on average, then they will make, this is 70 plus 50, 120 billion, which is half of the market capitalization in free cash flow. But still, if then the market capitalization crashes, then you haven't made much money. And you can see these ups and downs, up and down, up and down and up, and the next eventually will be down somewhere. So better to wait for those downs, downs and downs, because then the risk is lower and the return is higher. Now, pharma stocks, I'm not really a specialist on pharma stocks. It is an interesting sector, but okay, let's discuss. Pfizer, okay, benefited from the current environment. Really, they wanted to subscribe the whatever they do and have us get one every quarter. It didn't work, and let's hope that it doesn't work for the benefit of humanity. But they have their pipeline. You never know which one of this will work well, which one will not. So I'm not a specialist again. If you want to be a specialist, then you really should do well. But you can see the impact of the last 2 years on Pfizer. Tripled their free cash flows, doubled their revenues, and if things return to pre-pandemic levels, then this will also be an ugly one for Pfizer. So there is a significant risk, and the risk has started to be present also in the stock price, but we'll see. I hope it goes down for humanity's sake, but who am I to say there again something? And yes, it's cheap, and that's why also the market sees the risk, and that's why it is cheap. ABBV, Humira, the drug there, it's expiring patent next year, so these cash flows look great now, but will be lower next year, and that's why it is relatively looks cheaper. Broadcom, okay, really did really well over time, especially if we look at the stock price, so 15 times up over the last years, but now the price earnings ratio is 30, the dividend yield is there, okay, and then it all depends on the cyclicality on the sector, the future valuation, the future expectations. So let's say fairly priced in the current environment, and you have to see how this fits your requirements. Coca-Cola, also an holding by Warren Buffett, and here we can always discuss, should he have sold in 1999 or not. Buffett, of course, bought here 1988, 1989, then it boomed, and then it didn't do much for 20 years. He held, and he now has a dividend yield of 70% on cost. He spent about $1.2 billion. He now gets 800 million in dividends per year. But then again, price earnings ratio of 25, the dividend is there, the one that Buffett gets. And the management expects 8% growth ahead, but there is also competition, health issues, regulation. So, of course, they are booming in emerging markets, but that is the risk and reward. So the growth is, again, like with most other stocks here, the driver, and that is always a risk. And if you look at revenues, didn't go up much. Of course, they are selling the low margin businesses, focusing on the high margin businesses, but trying to balance things there, but not really much to show there. They're not even doing much buyback, so it's just the dividend, and they are using the cash flows to keep the position as is. It doesn't look great not to be priced as it is, in my opinion. CSCO, another good company, really good growth, and this has been a company that I have analyzed on my research platform, so you can, I'll put the link in the description below. So I have just updated, this is on free preview, so you can check it, and then you will see that I think I bought it a year and a half ago when the likely long-term price earnings ratio was much lower. Now it's 40% up, and now again, it is a game of valuation and how something fits your portfolio. They are doing now buybacks. They were lowering their debt and now they have focused on doing buybacks, but I don't think they will be able to do as much of those as they did in the last quarter. So free cash flow of 14 billion. If they reward investors with that money, so that again is a 5% free cash flow yield. If they grow 5%, then there you have it. It is a 10% return, between 6 and 10%, as you have the buybacks, the cash flows, and they really have projected good growth, really good backlog, so really good, and the business is projecting really good times ahead. So this is perhaps still one of the best in the bunch here from a risk reward perspective. The sector is growing and it's relatively cheaper than others, and the management is now focused on rewarding shareholders. The last one, Pepsi, similarly like Coca-Cola. So again, valuation trends, I don't know. For me, this is simply too expensive. Yes, those are good businesses, but too expensive. So I hope you have enjoyed this. It is, let's say, fairly priced. If everything stays as is, we'll discuss more than risk and reward next week. And tomorrow we'll discuss something better than most of these companies, which is Intel. But you have to understand it from an investing perspective, and that's what I will show you tomorrow.